Yeah, everything I'm hearing is that taxes are going up. I'm not hearing much about taxes going down. So,
Yeah.
especially if you're an upper incomer, you're definitely looking at potentially higher tax rates in the future, and you need to take that into consideration. Hey guys, this is Ray Halstead and Andrew McMillan here with REHCPA. Today we're going to get an update on what we're hearing about the Biden administration's thoughts on potential changes to tax laws. Andrew, what are you hearing out there?
Yeah, one question, or one thing we're hearing a lot is long-term capital gains and how those are going to be taxed under the new administration. Right now, if you have a long-term capital gain on an asset that you sell, and that's going to be like stocks that you've had for a long time, a mutual fund, maybe you bought a piece of land 10 years ago and you've
Maybe
done nothing
Bitcoin.
to it. Maybe Bitcoin. We put some videos out on that. So if you have a long-term capital gain, right now it's taxed at either a 0% rate, which is awesome, a 15% rate, or a 20% rate.
All depends on your income.
It all
right?
depends on your income. So those who are getting those 0% rates have a lower income. So you don't see it a whole lot, but sometimes you do. So right now they're taxed at lower rates, and right now the current administration is making a push to change that 20% rate to 39.6%, which is a pretty significant increase.
Yeah, that's huge.
And that really takes you back to what the top ordinary income tax rate used to be pre-Trump tax law.
Right.
President Trump put in some new tax law in 2018 that lowered the top tax bracket rate to 37%. Lowered
For
it
ordinary
for
income.
ordinary income.
Right.
So Biden wants to make it 39.6%, and it's a pretty
That's like
significant.
double.
It's
Yeah,
a pretty,
that's
it's a
crazy.
pretty significant increase.
Yeah, I thought
clearly.
20 was
So,
high when they changed the law on that because, whenever I was coming up, it was always 15%. And I remember the 20% was like, are you kidding me?
Yeah,
So
it's pretty large.
But
and
that's not for everybody,
It's not for
though.
everyone. Right now, the talk is that it would affect people making over $1 million.
Right.
So if you make over $1 million, have some long-term capital gain rates, there's a push that it will be taxed at 39.6%.
So
which
they're
would be-
definitely trying to increase the taxes more on the upper income.
They
folks.
are. They're trying to. So
Right. So that's a lot to think about. If you're potentially going to have a big sale of property or a business or something like that, and you feel like you're going to be in that upper income area of $1 million plus, there's some serious decisions that need to be made because you could potentially have a very big tax bill compared to going ahead and doing that transaction now. Hey guys, we really appreciate you watching this video today. We really hope that it's given you some insight into the tax and accounting and CPA world. If you find these videos interesting and they are of help to you, then please go to our YouTube channel and subscribe. We really appreciate your support. Now back to our video.
For sure. So something to think about, something to call your CPA about and to discuss. And that kind of leads me into the next, the next change that they're wanting to make is they want to get rid of the step up in basis. So what is a step up in basis? So that basically is when you inherit capital assets, like someone passes away and you inherit something from them, you get a step up in basis to whatever the fair market value is at date of death, typically. So when you sell it, you have your sales price less your basis, your cost basis. So oftentimes it wipes out a ton of gain there that you don't have to pay taxes on. For example, say you have a relative that passes away, you inherit their house, and you immediately sell it for $500,000. Generally, there's not much taxable gain there for you on that $500K, and you come out really, really good. So right now there is a push to get rid of that step up in basis because they view that as another tax avoidance strategy. Say the long-term capital gain rate goes through and now 39.6%, well then by default everyone would probably be like, well, I don't want to sell any of my capital assets. I will just pass away and let my heirs inherit them.
I mean, it's a great tax strategy.
So then they get that
currently,
step up in
right?
basis.
Yeah, because
So-
you hold on to it until you pass, and they get the step up in basis.
Yeah, so the step up in basis, unfortunately, is potentially on the chopping block to get rid of that.
Wow.
So
Yeah, that's a big change.
It is a big change, and I see a lot of problems with that because if you don't get that step up in basis, well, but now your basis is whatever the person who you received it from bought it for back
Right,
in
and
who
how are you
knows-
going to find that out?
Yeah, so it's really a tax record nightmare, honestly, because it's just really tough to track that number. And that's part of the reason why they have the step up in basis, because they realize, man, this is really cumbersome, really tough. It's kind of unreasonable, potentially, to even put that burden on the taxpayer to
Yeah,
prove.
it's going to be the burden
So
on the taxpayer.
It's going to be tough to. If that gets passed, it'd be a lot to keep track of. So
Yeah.
we'll see. I mean, all of this is just very speculative. Nothing's
right.
been passed.
Right,
This
to be
is all
clear,
just
none of
talk.
this has been passed. This is all what we're hearing.
Sure.
Yeah.
So, and the other biggest change that I seem to see a lot, and people are asking a lot of questions about, is payroll taxes on your W-2 wage. They want to beef up the Social Security tax. So if you're a W-2 earner, you get your income on a W-2, you have payroll taxes withheld out of that paycheck. And one of them is a Social Security tax, which is 6.2% of your wages up to $140,000. So if you have a $140,000 W-2, you're paying 6.2% Social Security tax on those earnings. If you make above $140,000 on a W-2, the 6.2% Social Security tax is capped out. You don't have to pay any, it goes away. So Biden wants to keep that. If you make $140K, you pay 6.2% up to $140K, and $140K is not exact. It's kind of, it changes every year, but it's around $140K.
Social Security sets it, right.
So, and then anything above $140K to $400,000 is still exempt, but if you got a W-2 over $400,000, they want to kick that tax back in at 6.2%. So 140K, you pay 6.2%. From 140 to 400,000, you don't pay that tax, but then it's going to kick back in on a W-2 over 400,000. You're paying that 6.2% Social Security tax. So I haven't heard that one before. That's kind of unique. It'd be interesting if that gets pushed through, but just another way to kind of beef up Social Security and another additional tax there.
So, yeah, everything I'm hearing is that taxes are going up. I'm not hearing much about taxes going down. So,
Yeah.
especially if you're an upper incomer, if you have a higher income, you're definitely looking at potentially higher tax rates in the future, and you need to take that into consideration, especially if you have any big events that that are potentially going to happen in the next couple of years, and you can potentially accelerate it and get it done now. It's definitely something to think about, because
Sure.
it does sound like things are going to go up, probably one way or another.
Sure. No.
Yeah. Really good information, Andrew. I appreciate it. I hope everybody listening enjoyed that, and I hope it gave you some insight into what we're hearing. Again, thanks for tuning in, and we'll see you next week.